Hi, this is Adam Khoo here, and I do hope you watched my video yesterday before the market opened where I talked about the fact that the stock market was on sale and it's not a time to panic, it's a time to actually start buying some shares of good companies at huge discounts. And if you watched my last video, I also said that the market would bounce strongly yesterday when it opened, New York time, which it did. And the reason I believed it would bounce was, I mentioned in the last video, that the price was very oversold. All right, so you can see, for example, on the Bollinger Bands, I mentioned that the price was below the lower Bollinger Band and stochastics was oversold. So it's like a rubber band, right, stretching down, is going to snap back. So sure enough, when the market opened, well, initially when the market opened, it hesitated a bit, but then eventually it kind of like shot up. So yesterday, the S&P gained 4.6%, 136 points. Very, very strong up day yesterday, right? And most of our favorite stocks in our portfolio had really good gains, right? Johnson & Johnson, Facebook, Alphabet, Amazon, Microsoft all went up. The question is, okay, have we hit the bottom? Is this the end of this correction due to the coronavirus? And are we going to see the market continuing the trend to all-time highs? Are we out of the woods yet? And the answer is, we may not be out of the woods yet, okay? Let me tell you what I'm looking for right now. So now that we have bounced, remember, there are two possibilities. The first possibility is that we have seen the bottom, right? And now that we have bounced, we're going to go all the way back up to make new highs. V-shaped recovery from a correction. That's a possibility, okay? But it is also a possibility that this is known as a dead cat bounce. A dead cat bounce means it's only going up temporarily as a relief rally because it's oversold, it's bouncing back up, but we have not seen the bottom yet. So we could be bouncing up and we could be hitting a level of resistance before plunging back lower to make a new low first. Okay, so which one is it? And the reality is no one knows. We can't predict the future. But having said that, we can prepare to take action if we see that it's hitting a resistance and it's going to go for one more leg down. There are things we can do to hedge our portfolio or to protect our investment portfolio. So as an investor, why do I like to hedge my portfolio? Because if the market comes back down again, now I know that the stocks that I buy are great companies, and I know that eventually they're going to go higher in the long run, okay? But in the short term, they will be going down. Now, I could, of course, sell the stocks, but I don't want to sell the stocks because they are good companies, I get dividends, I want to hold on to it. But in the meantime, as it goes down, I like to make money while it's going down. So how do we make money when it's going down? By shorting the market. Short selling the market. And there are many ways to short sell the market. We can buy inverse ETFs, I'll talk about it in a while, or we could use options by using put option spreads and butterfly combinations. And I'll share with you about all these amazing things we can do to kind of like profit as the market goes down. Why? Because again, as the market goes down for the short term, we want to make some money. So the money we make, we can then use it to buy more of our favorite shares at discounted prices so that eventually when everything goes up, we are able to grow our portfolio even more. All right? I tell people that if you want to make money consistently every single year, for example, you have to learn how to short the market. In other words, you have to learn to make money whether the market goes down or goes up. See, most people can only make money when the market goes up. And if you can only make money when the market goes up, you can't make money every single year. Because not every year will the market go up. There are years that the market will go down. So if the market goes down and you can't make money, all you can do is suck your thumb. You don't want to do that. You want to be able to profit in either direction. It's like to be a true Jedi. You have to learn both the dark side and the light side of the Force. Only then a powerful Jedi will you be. Okay, so I'm going to talk a bit about how do we profit by shorting the market in a while and hence hedging our portfolio. But for now, I'll talk about when I'll start to look for the next leg down to protect and hedge the portfolio. Okay, so what's going to happen right now is, again, the market is bouncing up, and I'm looking for a point when it hits a resistance. Okay, now the resistance could be a moving average or a Fibonacci level. So right now you can see that it is hitting this green line, and this green line is the 150 moving average. And you can see that previously this 150 acted as a support level, and this support level could now be a resistance level. All right, so it could, if the market is not able to break this resistance, if I see a bearish candle excuse me, a bearish candle closing, then there's a high chance we're gonna take that next leg down. Okay, now if it breaks above this green line, then it may reach the next resistance level, and the next resistance level could be this 100 moving average. And if it breaks above that, the next resistance could be the 50 moving average. So you never know which will be the resistance that's going to take it back down again. And that's why you have to wait for a bearish candlestick to form at the resistance before you start shorting the market. So let's look at the last time that this happened. And this was the mini bear market back in 2018 December. All right, so let's scroll back and let's see what we can learn from that. Okay, there you go. So this was that bear market that happened back in 2018. So you can see that we had this initial drop down, and it looked like it was recovering, but that was a dead cat bounce, right? Dead cat bounce, came back down again, and then we call this a double top pattern. This is a double top pattern, came back down again, and you can see it hits the 50 moving average. So again, these moving averages act as strong support as well as resistance level. So it hits the moving average, it resists the price, reverses all the way back down again. So we have to always watch these moving averages to be levels of resistance. Okay, and the moment you can see that it forms, it goes up and it cannot break the resistance, it forms the bearish candlestick pattern like so. We have to be prepared to short the market, to take some short-term profits as it plunges back down to a new low. All right. Those of you who have learned Fibonacci, if you have not learned Fibonacci, you can check out my videos on Fibonacci, where we use a tool called the Fibonacci tool, where we anticipate as well. We call this the A to B, right? And you can see over here, this is the 38.2% level, right? So it drops all the way down here. It goes up to the 38.2% level, which is the first level of resistance, comes down, goes up, again, comes down, and then it collapses. So we need to also look at these Fibonacci levels, because these levels also act as resistance, all right? So going back to where we are right now, where would we draw the Fibonacci, right? So Fibonacci would be, again, A to B, that way, right? So again, remember, when the market drops, it does not drop in a straight line down. Okay, nothing goes in a straight line. It will go down initially, and we have got a relief rally, right? And it plunges back down again. So this is the point where A to B is the wave down, B to C is the wave up. Okay, so the wave up will reach moving average or Fibonacci level before plunging down again. All right. The good news is that you can see that the first Fibonacci level, 38.2%, the market kind of like closed above this Fibonacci level, right? So it is it broke above this level, but now it's finding resistance at the 150 moving average. So I have to watch it tonight, or rather my time tonight, which is, you know, New York time when it opens, right? So if the market opens today and it is not able to break this green line, right? If the market closes below the green line of a bearish candlestick pattern, then I will have to start looking for ways to short the market to protect against the next plunge down. Okay, so having said that, what are the different ways we can short the market? Now, the simplest way to short the market and to profit as the market goes down is by buying an inverse ETF or a short ETF. So an inverse ETF is a special ETF that's designed to make money as the market goes down, and it moves opposite of the index. So for example, you can buy the inverse Dow Jones ETF or the inverse S&P 500 ETF or the inverse China ETF. So no matter what you're looking for, there's an inverse ETF to profit in the opposite direction. So for example, we could look at the short S&P 500 ETF, and it's known as SH. So SH is the ticker symbol. So as you can see, the name is ProShares Short S&P ETF. Now, of course, you can see that in the long run, the stock market goes up, right? So you can see, in fact, this was the last, this was the last 3 years. So the last 3 years, as the market went up, you can see this inverse ETF goes down. It goes opposite of the market, right? And recently, you can see that when the market plunged, right, the S&P plunged, this ETF went all the way up. So it goes opposite of the ETF, right? So again, if you think the market is going to go down again, then you buy this ETF, because when the market goes down, this ETF goes up and you make money. So that's one way, buy the inverse ETF. Now, personally, I do not use inverse ETFs because when you buy the inverse ETF, your risk to return ratio is 1:1. So what does it mean? Okay, so it means that, sure, if the market goes down, you make $1, for example, right? But if the market goes up, you also lose $1, all right? So you're risking 1 to make 1. And at the same time, you need to buy a lot, right, of this inverse ETF to match your investment holdings so that it can protect it. And to me, you need a lot of cash required to buy enough inverse ETF to protect your investment. So that's the limitation of using the inverse ETFs. So personally, I like to use options. Now, again, if you know nothing about options, please go to, again, YouTube and search Adam Khoo options. You can watch some of my basic option videos, an introduction to options. What's a call? What's a put? All the basic stuff, right? So go watch that first if you have no idea. So I'm assuming that you've got some idea of what options are, all right? So to make money as the price goes down, we use put options. So a put option is kind of like an insurance contract where we pay a premium to the insurance company to protect our house. So if our house burns down, we get paid the sum assured, right? It's the same thing, except a put option is an insurance contract on the stock market. So let's take a look at how I'll use put options to short the market if it starts going down, right? So let's look at the SPY. And the SPY is the S&P 500 ETF, okay? So the SPY mirrors the S&P 500, except it is a smaller dollar amount. So let's go back to this again. All right, there we go. So you can see it looks like the S&P 500, right? Okay, great. So again, if we are not able to break this resistance and we start to form a bearish candle, we are going to assume highly likely the price is going to go down from there, okay? So what's the current price right now? The current price now, let's see. Yeah, okay. Sorry. The current price right now is 309.09. Okay? That's the current price right now, 309.09. All right. So there are a few things I could do. The first thing I could do is I just buy a put option. We call it a straight put. Okay? So what would that look like? Let's check it out. So I'm going to go to my trade tab over here. And again, when you select options, I'm going to select put options. Okay. The next thing to do is to select the expiry date. So options have an expiry date. So you have to select the right expiry date. Now, when you buy a straight put, okay, you want to always exit 30 days before expiration, because in the last 30 days, the put will lose a lot of its time value. So you want to get out 30 days before expiration. So how long do I think it's going to take for it to drop back down again, for example? Okay, so it may take maybe 10 or 20 days for it to drop down again. So in other words, 10 or 20 days plus 30 days, because I want to get out 30 days before it expires, right? Which means the date to expiration, I'll choose above 30 days. So I could choose, for example, 45 days, right? So I'm going to choose this one, which is 45 days to expiration. This option expires on the 17th of April. So I'm going to open that up. There we go. All right. Now the current price is 309.09. So I could buy a put option. Now there's no right or wrong. It depends on your style. I like to buy a put option where the strike price is at the money, right, or slightly out of the money. So right now the SPY is at 309, so I'm going to choose a strike price at 309 is fine, 309 or 308. All right, so yeah, I could choose 308. That's my strike price. So by buying a put at 308 strike, what does it mean? It means that I have the right to sell the SPY ETF at 308. So even if the SPY drops to 0, I have the right to sell it at 308. I've locked in the sales price. That's what the strike price means. It means that you've locked in the sales price of this ETF. So I'm gonna click on buy, and let's see what it looks like. So you can see that to buy one contract of this put option is going to cost $12.97. One contract is 100 shares, so you have to multiply by 100. So 12.97 times 100 is the cost of this contract. Is, let me just write it down here, it's going to cost $1,297. So you can see that it is relatively expensive to buy a put. All right, one contract is going to cost $1,297. Relatively expensive. So I'm going to show you a much cheaper way in a while, right? So this is a more expensive way, okay? Now, you can see that by buying this put, what happens? My maximum loss is 1,297. So if I buy the put and the market doesn't go down, if the market keeps going up, my option will expire and I will lose $1,200. Ouch, right? But if the market does go down, you can see my maximum profit is $29,000. Now, of course, that will never happen. That's if the market goes to 0, then you make $29,000. That's not going to happen, obviously, right? So don't get too excited by that. But the point is that this is going to cost us $1,200. And that's the maximum we can lose if the market doesn't go down, if the market goes up instead. So there's a better way of doing it, which I'm going to show you in a while, right? So let's take a look at the profit and loss chart of this particular trade. Okay, great. So this is what it looks like. So on the y-axis, we have got the profit and loss. So this is a 0 line. Okay, so above that is profit, below that is loss. So you can see here you make $10,000, $20,000, $30,000, and if it goes down, you lose money, right? So currently, we are now here. This is the current price right now. Let's look at the current price again. Let me reset the slides. Okay. So currently, we are here. This is the 306.62, right? This is the price right now, okay? So again, you can see if the market goes up, right? The market goes up, what happens, right? We could lose the maximum amount of money, okay? But if the market drops, what happens? You can see the more the market drops down, the more money we're going to make, okay? Now, of course, the market's not going to drop to 0. Where do I think the market's going to go? Let's look at the charts over here. All right, so from the charts, you can see that if we do go back down again, my target on the downside will be the previous level of support, which would be at 284, or about 285, right? So in other words, Right now we are at about 30. Yeah, well, if it closes bearish, we'll be at about 306, right? So in other words, we are right now at 306, or we could be at 306 if it closes bearish. And from 306, I target that it could go back down to 285. So let's see how much money we'll make if that happens. Okay, so let's go back to our analyze. So let's study the profit and loss chart. So once again, if we enter the trade, if it closes bearish, we'll probably get in somewhere at about 306. So somewhere about there. Yeah, somewhere about there, right? Okay, now the date today is the 3rd of March. Let me set this to the 3rd of March. Okay, there we go. Okay, so again, if we were to see the market go down and it goes to our target of 285, how much would I make? So I'm going to shift this to 285. There we go. All right. And assume that we exit 30 days before expiration, which will be the 17th of March. So over here, I'm going to simulate what the chart looks like on the 17th of March, somewhere there. Okay, there we go. All right. So again, at 285, I will make 1269. I'll make $1,269 profit if it goes down, right? Now, if it goes up and the options expire worthless in 45 days, I could lose $1,200. So you can see that when you buy a straight option, the risk to return ratio is not that great all the time. In fact, you may say, hey, I'm risking $1 to make $1, 1-to-1. That's not really good, right? But here's the thing. In reality, I never allow myself to let the options expire worthless. If I notice that the market is not going down but going up instead, I will exit way before expiration. I'll exit 30 days before expiration, which would again be the 17th of March over here. All right, so let's go back to the charts, and you can see that once again, if I'm going to short over here expecting it to go down and it doesn't go down and it goes up instead and it closes back above the 150 moving average, I would cut my loss, right? I'll get out of the short trade. So if it goes back up to say 311, right? 311, I'll cut my loss. How much would I lose in that case? So at 311, let me drag this to 311, I would lose about 329, right? $329 potential loss. If I cut loss early, I'll lose 329. So you can see that when you manage the trade actively and you cut loss early, way before expiration, when you cut loss when the market closes back above the resistance level, you will be able to minimize your loss to, in this case, 329, which means my actual risk is 329 and my potential profit is $1,200. That's a lot better. So in this case, I'm risking, in a way, $1 to make about $4. Yeah, about that, right? So risking 1 to make 4, not too bad. Pretty good trade, all right? Now, question is, can this be even better? Yes, it can. And in the next part of the video, in part 2 of the video, I'll be talking about how I use vertical put spreads and even a butterfly spread, where I can further reduce the cost of the trade, where it's only a few $100s, and massively improve the risk to return ratio. So do watch part 2 of this video coming up really soon. But before you watch part 2, a very important disclaimer. Please do not trade options live until you've taken a proper full education course on options, either from someone else who is legitimate or from me. It doesn't really matter, right? Because people who trade options without fully understanding the intricacies of how to cut loss, how to take profits, how to look at the, the theta, the delta, the gamma, is really, really risky, right? So options, again, they're like a nuclear weapon. Use it properly, you can make a lot of money and protect your portfolio. But if you misuse it, it can be disastrous. So once again, please do not trade this live before taking a full education course. You can take it from someone else, that's fine. If you want to take it from me, you can go on to piranhaprofits.com, check out our professional options trading course available online for anywhere around the world, or for anyone anywhere in the world. Okay, so with that, I'll see you guys in part 2 of the video. Take care, and hope I've opened your mind to the power of shorting the market using options. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.